In this episode of Where Carbon Meets Capital, we explore the opportunities associated with proactive stewardship by private market investors, the unique position of the investor community to influence real-world emissions reductions, and the role of technology in enabling asset managers to benefit from the transition to net zero.
As the world transitions to a low-carbon future, private market investors are facing growing pressures to reduce their financed emissions. They face a range of financial, regulatory, and stakeholder pressures, driving them to embed climate risk into their investment decision-making and portfolio management practices.
Climate change is probably the most profound disruptive force that communities around the world will have to face this century. For asset managers, the pressures are numerous. There's everything from regulatory risk to having to manage operational risk in portfolio businesses to meeting the expectations of investors. And then there's also the legal and reputational risks that come from greenwashing and from increased community activism. There is also the impact of climate on valuations, and that has a very strong link to the fiduciary responsibilities of asset managers.
Climate change being the greatest challenge of our times, it's essential for asset managers to remain relevant in the market, to include those considerations in their processes. There's convergence around climate and ESG in the regulations, quasi-regulations with ISSB and TCFD, and very soon actual regulations that will be enforced in most parts of the developed world. But waiting is not really an option.
At the same time, investors are becoming increasingly aware of the investment returns and value creation opportunities from integrating climate risk into their investment lifecycle.
We spend a lot of time talking about the challenges and the risks that come with climate change, and probably not enough time talking about the opportunities. Beyond preserving value, which is obviously important, the scope to create value is even more immense. When I think about measuring and reporting on climate risk, I think about it as the foundation upon which value accretion can be built. Now, that could look like developing new products and services, particularly where markets are willing to pay a green premium. There's also the opportunity for businesses to expand into what I would call net zero adjacencies. Ultimately, a net zero economy will require a whole series of new technologies and businesses that today, at best, may be nascent, but tomorrow will become mainstream. Private capital investment, working together with policy settings, will be key enablers of this transition.
The opportunities from this megatrend are enormous and vast. There will be a period of 10 to 30 years of immense change in the economy, and players will be rewarded for decarbonising processes within their business. That might be through a premium they can charge for their product or service, or ultimately just complying with net zero targets that are set by governments globally. So really, in thinking about the opportunities, it's about identifying those businesses that have process and solutions that are going to create that decarbonisation in future processes. And if you look at the most intensive industries and processes out there, that's probably the lowest hanging fruit, where you can have a real impact by decarbonising.
In response to these market pressures and opportunities, asset managers are beginning to integrate climate thinking into their stewardship activities, actively engaging on the topic with their investments. This can involve influencing companies within their portfolio to set and implement net zero or low carbon ambitions.
The Australian Investment Council endorses UNPRI, and within that, its definition of stewardship. Stewardship is effectively about using investor influence to maximise the long-term value of assets, including economic, social and environmental ones. It necessitates working with a range of stakeholders, whether that be portfolio businesses, policymakers or service providers. At its heart, stewardship recognises that managers and allocators of capital have immense influence, and with that comes responsibility, not just for investor returns, but also for community outcomes.
We've really seen asset managers who proactively go and work with these companies and set a baseline and implement a transition plan of how this company is going to move in the next 10, 15 years as we move to a low carbon economy, really doing well and really exceeding in terms of their investment returns. So where you're able to actually go in and baseline and put a plan in place, we often see those assets actually outperforming in an investment portfolio.
Private market investors are in a unique position when it comes to stewardship, as they often have controlling interests of their portfolio companies and/or positions on boards, meaning they can influence their investments to reduce their greenhouse gas emissions.
Private capital invests across almost every sector of the Australian economy. It's highly influential in how privately run businesses can not only meet the challenges of climate change, but also realise some of those opportunities. Assets under management across private capital, infrastructure, real estate and natural resources is probably around $118 billion last year. Of that, private capital, being private equity, venture capital and private credit, was probably about half of that amount. Private capital investment contributes about 3 to 4% of Australia's GDP. That's substantial and really has the potential to shift the dial.
Private market investors have a unique relationship with the assets that they invest in. And it can range from very early venture capital days all the way through to growth equity. And within that relationship of trust, they are very involved in the company. They have the means to speak to management, to understand the operations of the business and to have a real input in what happens in terms of decarbonisation. Unlike public markets where there really is no direct engagement often between the asset manager and the assets they invest in.
However, private markets can be complex in terms of ownership structures, reported data, and the availability of granular information in a consistent and usable format. This is the complication for private markets. They haven't traditionally been structured to facilitate transparency, and so it's not easy for private market investors to know what stewardship activities can and should take place across their portfolios. Stewardship needs to be based on informed decision making, and the data to inform it simply isn't there.
When we look at the coverage of financed emissions reporting in an investment portfolio, we've seen great progress being made in the listed side of the portfolio, and that's often because those companies are putting out public disclosures, and the challenge with using that information is simply gathering it all together in a way you can use it. In the unlisted side of the portfolio, that public information does not exist. So what's happened to date is a lot of proxy information being used to estimate the emissions in the unlisted side and very little progress being made year on year.
Fortunately, all of this is changing with a number of key developments. The introduction of common frameworks to measure and disclose information about climate change and particularly emissions, and also with technology that is emerging to help standardise and scale the sharing of information.
One of the benefits we've seen recently in the industry, though, is the standardization of methodologies and data quality score to understand the emissions profile of an investment portfolio under the PCAF standard. The standard is very important because it sets out a clear set of methodologies per asset class that can be applied consistently by various service providers and financial institutions to consistently report the carbon profile of their investment portfolio. This is huge in lifting the industry to a space where numbers become comparable, data quality is understood, and then the real work can begin with decarbonising a portfolio.
There's a lot of technology can help with when it comes to carbon, because the carbon accounting rules now are quite well understood and set. So there is an opportunity to automatize, to collaborate around carbon by doing it once and sharing it multiple times. And technology, importantly, is allowing scalability, so do it on a very, very large scale for lots and lots of companies.
These technologies can also connect market participants, from asset owners to asset managers, all the way to their portfolio companies, in order to share valuable emissions information in a way that spreadsheets and emails never could.
Stewardship for asset managers needs to be based on information. This information needs to be consistent and needs to be readily available, up to date. And that's where technology can play an important role. If we enable the connection between the portfolio companies and the GPs and ultimately the investors, that information flows all through a network that both GP and asset owners can use to make informed decisions.
Asset managers are uniquely placed to play the middle role, the connecting role between asset owners and portfolio companies to create the bridge so that the information can flow from asset to asset owner. When looking at the estimates that an asset manager can generate to understand what emissions might be in their portfolio, it's important to understand that we need to move from estimates to actual data from these portfolio companies. Even if you could perform a really good estimate by taking in all sorts of other data about the company, you still would not be able to see what plans have actually been put in place at that particular company to decarbonize. And secondly, you would not be able to see how that may have changed year on year as they track their progress. For example, if you have a fleet that might be mobile combustion, that's a big source of emissions. If that company's actually switched out to electric vehicles to reduce those emissions, that would not be seen in any estimate that could be created based on proxy information.
While climate change is one of the greatest of challenges, I also think of it as one of the greatest of opportunities for private capital. It's not just a means of responding to regulatory or investor scrutiny, but it's also the ability to build a foundation upon which the industries of the future will be built. Investing in the net zero economy is what private capital is all about. It's about investing in ideas, businesses and communities now and into the future.